Good day. Welcome to another session of Folk Accountancy Tutorials. We are continuing our lesson on marginal and absorption costing today, and I would want you to subscribe to this channel if you are yet to. Kindly subscribe to this channel, share this video, and let others also have a benefit. Now, I told you in the previous video that in this video we are going to look at a practical question involving profit estimation under marginal costing and then absorption costing approach. And that is exactly what we are going to do. I always tell you I don't want to waste much time. Let us go straight to the point and then look at the question together. The following figures were extracted from the books of Same Boy Complex Limited for the year ended 31st December 2017. So we have sales to be 16,000 Ghana cedis. We have direct materials to be 4,000 Ghana cedis. We have direct labor to be 3,000 Ghana cedis. We have factory overheads to be 3,000 Ghana cedis. Selling costs to be 2,000 Ghana cedis. Distribution costs to be 1,000 Ghana cedis. Administration costs 1,000 Ghana cedis. And then we have the units sold to be 2,000 units. And the units manufactured was 2,500 units. Okay. Then we are continuing. 40% of selling, distribution, and administrative costs are fixed, and third of the factory overhead can be assumed to vary directly with production. That is a variable cost. You are required to A. Prepare the profits or loss statement for the year ended 31st December 2017 using the method of I. Absorption costing, II. Marginal costing. Then B. Explain the difference in the profit figure disclosed by the two methods in AI and II above. Okay. So we are going to solve this question for Same Boy Complex Limited. And what we are going to do is that we are going to calculate profit under the marginal costing system and then under the absorption costing. So we will reconcile the profit afterwards. So let us look at that. Same Boy Complex Limited. Statement of profit or loss. For the year ended 31st December 2017. Under absorption costing. So let me put that in brackets. And then let me do same for the marginal costing. Statement of profit or loss. For the year ended 31st December 2017 under marginal costing. So let me show my currency signs for each of them. So let's deal with the absorption costing first, and then we can come back to the marginal. So let's begin. In the question, the sales was given. The sales figure was given as 16,000 Ghana cedis. So we begin with our sales. 16,000 Ghana cedis. Then we less cost of sales. So we begin with our opening inventory. But in this question, there was no opening inventory. If you look at the question carefully, there was no opening inventory, but there was closing inventory, and there should be closing inventory so that we'll learn how to value this. Now, how do we know that if there was a closing inventory? Look at the list of balances that was given. The last two were told that the units sold is 2,000 units, but the units manufactured was 2,500 units. So in other words, you produced 2,500 and you sold 2,000. So the extra 500 you didn't sell will become your closing inventory. That is how it is done. So let us take note of that. The closing inventory will be given as 500. And now the 500 that we have here is 500 units, but we are working in series, so we need to value it. It has to be given a value. And how are we going to value it? That is where the differences I was talking about will come in. So we are going to learn how to value them using the cost of production calculated. So over here we take out our cost of sales. There was no opening stock in this question, and so we begin straight away with your production cost calculation, which is a direct material. So there was direct material, and because there is no opening stock, I can calculate them straight on the second currency sign. The value for direct material cost is 4,000 Ghana cedis. And then there was direct labor cost. Direct labor cost was 3,000 Ghana cedis, according to the question, if you can verify. And then we were given factory overhead. Now, let me say something about the factory overheads. If you look at the list of balances, we are told that factory overhead is 3,000 Ghana cedis. But in the additional information, we are told that 40% of selling and distribution and administration costs are fixed. Fine. And a third of factory overhead can be assumed to vary directly with production. So the factory overhead cost that we have for 3,000 in there, we are told that a third varies directly with production. A third means 1/3. And so it means that 1/3 of the factory overhead is variable. That is the meaning. Varies directly with production. So it's variable cost. And that means automatically 2/3 will be fixed cost. But those splitting of percentages into fixed and variable components will be needful for the marginal costing. When it comes to absorption costing, it is full cost costing. We don't need fixed and variable breakdowns. So I'm just drawing your attention that we are going to use all the 3,000 for the cost of production calculation under the absorption costing. But when we come to marginal costing, that is where I will take my time and then work out the percentages with you. So for now, let us take it. Whether fixed components or variable components, we are bringing all. So both fixed and variable. So we'll say factory overhead will be 3,000. So now that factory overhead is 3,000, we are getting a cost of production to be 10,000, which is the same as the cost of sales because there was no opening stock. Then we less our closing stock. And this is where I want you to pay attention, because the figure for closing inventory has not been given, but we are only giving the units as 500 units. We produced 2,500 units and we sold 2,000 units. So that means there is a closing inventory of 500 units. And how are we going to value that 500? Watch how I'm going to value it. You see that this 10,000 is the cost of production. So we are going to value it based on the cost of production. So if we are saying that we produced 2,500 units, is that not it? We sold 2,000, but we produced 2,500. And 2,500 units cost us 10,000. Then how much will 500 cost us? That is how to value closing stock. If 2,500 units is costing us 10,000, how much will 500 cost us? So you can do your 2,500 maps to 10,000 and then 500 maps to X. You do your cross multiplication and you get, if more, less divide, if less, more divide. So we are looking for the less. So we can straight away see this is how you go about it. Closing stock valuation. Closing stock valuation, 1, absorption costing valuation. So that is the first working. Under absorption costing, we will say 500 units over 2,500 units. The 500 units is the value of the closing stock in units. The 2,500 is the total production times the cost of production, which is 10,000 Ghana cedis. So it means that if you compute and you get a wrong cost of production, you are also going to get a wrong value for your closing inventory. And that is going to give us 2,000 Ghana cedis. So it means that the value of our closing stock and the absorption costing is 2,500. 2,000 Ghana cedis. And so closing stock, we less closing stock 2,000. So we can say from working 1. You see, so as we have gotten 2,000 Ghana cedis as the closing stock for the absorption costing, we are not going to get the same closing stock for the marginal costing. So take note. All right. So when we take that out, it gives us a cost of sales of 8,000 Ghana cedis to be subtracted from the sales of 16,000, which will eventually give us a gross profit of 8,000 because we are dealing with absorption costing. So now that we've seen our gross profit to be 8,000 Ghana cedis, then we can less non-factory overheads. That's the meaning. And in this question, the non-factory overheads are the selling cost and the distribution cost and those ones. So we have the selling cost to be 2,000 Ghana cedis, distribution cost to be 1,000 Ghana cedis, and administration cost to be 1,000 Ghana cedis. So those are three expenses or non-factory overheads. So we have selling cost to be 2,000 Ghana cedis, distribution cost to be 1,000 Ghana cedis, and administration cost to be 1,000 Ghana cedis as well. So when we add up, we have a total non-factory overheads of 4,000 Ghana cedis. And when you subtract 4,000 from 800, you have a net profit of 4,000 Ghana cedis. So under the absorption costing, we got a net profit of 4,000 Ghana cedis. So let us apply the same figures, but this time using the marginal costing approach to see if we are going to get the same profit. And when we have a different profit, the second requirement is we should reconcile the profit. Prepare a statement of reconciliation, which I'm going to teach you as well. So just like that of the absorption costing, we begin with the sales, which is constant. The same figure, 16,000 Ghana cedis for sales. Then we less, this time we say marginal cost of sales or variable cost of sales. We less our marginal cost. So over here too, there is no opening inventory. We start directly with your direct material. And bear in mind that we don't entertain fixed costs at the top before the contribution. So direct material cost is the same here, 4,000. The direct labor cost, I told you, is also variable. So 3,000. But when it comes to the factory overheads, that is where there will be a challenge. Because we are told in the question that a third of the factory overheads is variable. So it means 2/3 is fixed. And we cannot bring in the fixed factory overheads in the calculation of our marginal cost under the absorption costing. So we have to first of all take out the fixed factory overheads. So only 1/3 is variable. And so we are going to say the factory overheads. We can open up a bracket and say 1/3 times 3,000 because the value is 3,000. So we just take 1/3 and that is going to give us 1,000 Ghana cedis. So our cost of production becomes 8,000. So you see that we only factored 1/3, which is variable over here. But when we were doing the absorption costing, we took all the 3,000 and that gave us a total cost of production of 10,000. And over here we are going to have a cost of production, a marginal cost of production of 8,000. Then we take out the closing stock. So we are going to do a different stock valuation for the marginal costing. So we less our closing inventory or stock. Now the closing inventory for marginal costing, okay, is the same 500 units. Nothing has changed over the same 2,500 units produced. But we are no longer multiplying by 10,000. This time we are multiplying by 8,000. I hope you are understanding what we are doing. And when we multiply by 8,000, it's going to give us 1,600 as our closing inventory under the marginal costing system. And so closing inventory, we say working to 1,600. And you see, from the beginning of this lesson, I explained to you that the main difference or the reason behind this is the valuation of closing inventory. Because absorption costing permits the valuation of, the inclusion of fixed production overheads in the valuation of closing stock. But marginal costing does not include fixed production overheads in evaluation of closing stock. And that is even how we are going to answer the second requirement for the reconciliation aspect. This is it. Okay, now that is what we have to do. There are cases where you will be given the unit cost for each of them. Unit cost for direct material, unit cost for direct labor. And so when you are adding up the units to value closing stock, please, in that case, you get the total unit production cost and you multiply by the 500. Still, when you are doing it under the marginal costing, you do not include the unit fixed cost or the fixed cost per unit. You don't include that because we do not need that in the valuation of closing inventory. So we are done with that. So now that we know our closing inventory to be 1,600, okay, let me also talk about something important I may not have spoken about because it's tricky. Assuming there was an opening stock for both of them, assuming there was an opening stock of 200 each, okay, that would have made the cost here to be 8,200. But the question is, if there was an opening stock of 200 and we have 8,200 here and we are doing valuation for closing stock, are we going to still use the 8,000 or we should use 8,200? There is a trick. The question and the answer is that you still have to use the 800. The opening stock is not part of cost of production. What I said from the beginning is that when we are valuing closing stock, it is the cost of production that we use, not the cost of goods available for sale necessarily. Over here, it is just a coincidence that the cost of goods available for sale is the same as the cost of production. Remember that I told you that when the opening stock comes up here, we are going to calculate this cost of production 8,000 on the first currency sign before we bring it here. And when we have 8,000, we add the 8,000 to 200 to get 8,002. And when that happens, your focus on the valuation of closing stock is not on cost of goods available for sale. Your focus is on the production overheads. So even if you didn't do it by shifting, but you still added it all to get 8,200. When you are doing the valuation of closing stock, please and please again, exclude opening inventory. Opening inventory is not part in the valuation of closing inventory. We only need the raw cost of production for the calculation of closing inventory. And the same applies to the absorption costing as well. So please take note that it is not the goods available for sale that I multiplied necessarily, but it is the cost of production that I need for the valuation of closing inventory. Okay, so now that we have taken out closing inventory of 1,600, we have 6,400. Now we should have taken it here to subtract, but remember that there are other variable costs that we must add before we take it out to get contribution. So now that we have 6,004, we say add other variable costs. And those other variable costs is what I'm going to talk about. Now, in this question, we were told that 40% of selling, distribution, and administration costs are fixed. So what does it mean? It means that the other 60% are variable. 40% of selling, administration, and distribution costs are fixed. So 60% it means is variable. So you see this selling cost, distribution cost, and administration costs that we have over here. We have to calculate 60% of each of them as a variable cost, bring them up in the computation of our contribution, so that the 40% that is fixed will be taken off after we have gotten our contribution. I'm sure we understand this very well. And so we'll say other variable costs. We start with the selling cost. We can calculate 60% of 2,000, and that is going to give us 1,200. Then also distribution cost. We find 60% of 1,000. That is going to give us 600. And then the administration cost. We find 60% of 1,000, which is also going to give us 600. So now we are set with the variable costs. When we add them, then we are going to get total variable cost or total marginal cost to be taken out of sales to get contribution. And that is going to be 8,800 Ghana cedis. So when we take out 8,800 from 16,000, we have 7,200. And we are not going to call it gross profit. No, we call it contribution. Someone may say contribution. Okay, so we have our contribution to be 7,200. And now that we have contribution, we take out other fixed costs. So you now see less fixed costs. So you see that the approach for marginal costing is very different from the approach of the absorption or the full costing. So less fixed cost. Now with the fixed cost, we already know them. The factory overheads was 3,000 here. We took 1/3 as variable. So the 2/3 is going to be fixed. That is the meaning. So fixed factory overheads, which is 2/3 times 3,000, is going to give us 2,000 Ghana cedi. So that is now the fixed component of the factory overheads has been brought down. And then also this selling, distribution and administrative costs also have their fixed components. According to the question, they are 40% each. So selling cost will be 40%. You can calculate it in bracket like that. 40% of 2,000 Ghana cedis, giving you 800 Ghana cedis. Then you have distribution cost to be 40% of 1,000, which is also 400. And then finally, administration cost to be 40% of 1,000, giving us another 400. Then we can add them up. So when we add that, we have a total of 3,600 for the fixed cost. So we subtract 3,600 from 7,200, and then we have a net profit of 3,600 Ghana cedis for the marginal costing approach. Now, ladies and gentlemen, as you can see, the profit and the absorption costing is 4,000, but under the marginal costing, we are getting a profit of 3,600. There is a difference, and the difference is coming because of the valuation of closing inventory. You can see that the difference between closing inventory is 400, and that 400 is what is reflecting in the profits. Okay, now let's look at the last requirement. It says that explain the difference in the profit figure disclosed by the two methods. I have explained this over and over through my explanation. So, okay, he's just saying explain. So what we are saying is that the B wants you to at least write some English, talk on the reason why the profits are different. So you can say that the profits are different because marginal costing does not include fixed production overhead. Listen, this is what you write because it's more of a theoretical exam. Marginal costing does not include fixed production overheads in the valuation of closing inventory, but absorption costing includes fixed production overhead in the valuation of closing inventory, and that is what is causing the difference. And we can see from that. Now, sometimes you need to prepare a short statement of reconciliation to support your answer, and this is the statement of reconciliation. It's not any big statement, it's just a 3-line statement. Statement of profit reconciliation. Under the two methods, you will say, you can start with any of them. You can start with the absorption costing profit or marginal. If you are starting with the marginal profit of 4,000, then you subtract the 400 to get the 36. If not, whatever it is. Now, you say that you can start with absorption costing profit, which is 4,000. Now, you are going to take out the 400, but the 400 is not automatic to be taken out. It's about the valuation. You see that when we were doing the valuation for absorption costing, the cost of production was 10,000, but the marginal costing cost of production was 8,000. The difference of 2,000 is the fixed production overheads, these 2,000. That was not included. So what you need to do is that use the 2,000 as a proof and apply it on the same fraction, 500 over 25. You see that if you calculate 500 units over 2,500 units times 2,000 that was excluded, you are going to get 400. And this 400 that you are getting is the difference in the profit. Okay, so you can say absorption costing profit. Then you say less fixed production overheads valuation. Then you can show this working here. 500 over 2005 times 2000. And that's giving us 400. So when we take out the valuation of the closing stock using the fixed production overheads, it's going to give us the marginal costing profit of 3,600. Now, if you had started, you could have started with the marginal costing and then add the 400 to get 4,000. But you need to explain the 400 as the value of the fixed production overhead that was not included in the valuation of the closing stock. And that is just the reason for the B. So when you make this statement, when you prepare this statement of reconciliation, then you write English. In fact, the writing of the explanation is even more important than what you've done, because they are saying explain. So after this, you say that this is because the absorption costing does not absorption costing permits the fixed production overhead to be included in the valuation of closing stock or inventory, but marginal costing does not permit fixed production overhead to be included in the valuation of closing inventory. And we know that when the value of inventory is changing, profits changes, because the higher the closing inventory, the higher the profits. All right. And so, ladies and gentlemen, this brings us to the end of our lesson, part 2 of this lesson on marginal and absorption costing. I'm sure you have really been helped, which I'm happy about that. In the final part, which is the part 3 of this lesson, I'm going to talk about over and under absorption of overheads. And we are going to take a question that involves over and under absorption of overheads. And then we'll be done with marginal and absorption costing. Remember to subscribe to this channel, share the video, and let others also have a benefit. Until we meet again another time, it is bye for now.